The dollar remains strong as bond yields remain highly sensitive to the Federal Reserve's benchmark rate policy. But with stocks at a discount right now, are equities a better bet than bonds heading into 2023? HSBC's Private Banking and Wealth Management Global Chief Investment Officer Willem Sels joins us now to weigh in. Okay, so give us the take here and the thesis. Where should we be positioned going into the next year?
Well, the thesis is that many assets have become cheaper between 22 and 23. Cash rates are up, bond yields are up, price earnings yields on price earnings ratios on equities are down. But clearly, the relative risk is completely different. So the basis for our preference for bonds is that we are seeing, the peak in Fed rates approaching. The 5% peak that we are expecting for the Fed is already priced in the bond market. And obviously, between bonds and equities, the difference in drivers is really the economic cycle. A slowing economic cycle is bad for equities, but should be good for safe haven bonds. So that's why we position in short-dated bonds. We think that earnings still need to be revised down in the equity market. And until that has basically bottomed, those earnings revisions have gone to a 0% earnings growth for 2023. Until that point, we're underweight on equities.
Did you say 0% earnings growth for 2023?
We do think that in Europe, you need to go into an earnings recession, and in the US, you need to go towards about 0%. Currently, the consensus is still around 6% earnings growth in 2023 in the US.
Well, let's stay on the bad news here. I'm sure you're watching what's happening in crypto. It's been a heck of a week for this industry. Do you see this spilling over into equities? Now, so far, it has not. But when you hear FTX filing for bankruptcy like it did about a half hour ago, that's really negative news. How doesn't it impact stocks?
It is interesting, right? Even in the different, there are cryptocurrencies that are up today. Even contagion within the cryptocurrency market, not that big. I do think that there are, other drivers that are really grabbing the market's attention. And to some extent, people are trying to push the dollar down. Now, clearly today it has this safe haven appeal when you have the cryptocurrency turmoil. But basically, the consequence of the story and the thesis that we have that the Fed is close to its peak of interest rates would also be that we are close to the peak of the US dollar. Now, before people get very enthusiastic about currencies like the euro and sterling, we do think that you also need to see a bottoming of economic activity there, which, is not yet the case. But the slowing of the momentum of the US dollar allows, assets of lower quality, to be somewhat more resilient.
What type of hit on earnings do you expect foreign exchange and the strength of the U.S. dollar to be on some of the most international companies?
So sorry, I didn't get that.
Sure. As we've continued to hear companies talk about the FX headwinds and cite that in the course of this earnings period, for how long and to what extent do you believe that hit will continue?
So it tends to act with a lag. Even if the dollar were to stabilize today, you will still see some consequence of that in the earnings over the next 6 months, I would say, and then but then it starts to fade. I do think that when you look at where to invest in the world, obviously. There is, FX is an important element, right? So as a U.S. investor, you may think that European companies are getting the benefit of a weak euro or have had that benefit in terms of competitiveness, but you probably are not going to hedge your euro exposure. Typically, investors don't do that, so they would have a loss on the currency from an investment perspective, whilst the company would potentially do somewhat better if it is obviously an exporting company, because if it is a local European company, then it is suffering from the local activity there being relatively weak.
Well, I want to go back quickly to what you mentioned before about an earnings recession. What is that exactly? How do you define that?
So earnings recession would be when earnings growth is negative, and that obviously is basically a consequence, particularly of slowing economic activity. That's the volumes that companies sell, but also of margin pressure. And so far, companies have actually surprised to the upside, certainly in the first half of this year, by being very resilient in terms of margins. People had expected that input costs that are rising, would be would put pressure on margins and would compress those margins. A lot of the companies have been able to pass those prices on because demand was relatively strong. You had the reopening. Now that you have a slowdown, now that you have built up inventories and companies actually want to get rid of inventories, in some cases, those margins are being compressed, and that can lead to shrinking profits. We've already seen profits growth come down, but it should come down further.
HSBC Private Banking and Wealth Management CIO Willem Sels, thanks so much for joining us this morning. Appreciate it.
Pleasure.